Why keeping more than $25,000 in a single bank account is quietly working against you in 2026, and most people have no idea it is happening. This is not the number your bank displays on your monthly statement. It is not the balance you pull up on the mobile app every morning to confirm everything looks right. It is a different number entirely, one that lives inside a federal compliance algorithm running silently at your financial institution right now, analyzing every transaction you make in the background every single day without your knowledge or awareness. If your checking or savings account balance regularly sits above $25,000, you are simultaneously losing money in three completely separate ways: attracting regulatory scrutiny you never invited, and directly funding your bank's lending operations at interest rates you will never see a fraction of. None of this requires you to have done anything wrong. None of it requires unusual behavior or suspicious activity. It simply requires keeping more money than necessary sitting in the wrong kind of account. This video explains exactly how that mechanism works, what the real thresholds are, why the number most people monitor is not the number that actually matters, and where financially knowledgeable professionals keep their own liquid savings instead. The story that explains everything. Consider a retired electrician, 68 years old, 34 years with the same union, fully paid off house, and approximately $140,000 in a savings account at the same bank he had used since he was 19 years old. He was not wealthy. He was disciplined and careful with money throughout his entire working life. Last winter, he decided to help his daughter purchase her first home in Florida. The down payment was $22,000. He had been quietly saving for exactly this kind of moment his entire career. He walked into his local branch on a Tuesday morning and requested a cashier's check made payable to the title company handling the closing in Tampa. The teller glanced at the screen, then asked him to please take a seat. A branch manager appeared, guided him into a private office, and began asking questions. Why did he need the funds? Who was receiving them? Had anyone instructed him to make this withdrawal? Had he received any unexpected phone calls or emails recently? Had he met anyone new online in the past several months? A 68-year-old retired union electrician was being formally interrogated by his own bank about helping his own daughter purchase a home, with money he had earned and saved across decades of hard work. The branch manager informed him the withdrawal would require a 48-hour compliance review before the check could be issued. He had to call his daughter and explain that the real estate closing would need to be rescheduled. When the cashier's check finally cleared 2 days later, he assumed the matter was completely behind him. It was not. 3 weeks later, a written notice arrived from the bank. A suspicious activity report had been filed on his withdrawal with the Financial Crimes Enforcement Network. That report now sits inside a federal database that will be cross-referenced against every financial transaction he makes for the next 5 years. He did absolutely nothing wrong. He is a retired electrician who wanted to help his daughter buy her first home. The only thing that set this entire chain of events into motion was maintaining too large a balance in a single retail bank account. That is what this conversation is about. The two rules, the one everyone has heard of and the one that actually matters. The currency transaction report threshold is the rule most people are at least vaguely familiar with. Under the Bank Secrecy Act, any deposit, withdrawal, or transfer involving more than $10,000 in cash from a financial institution in a single business day requires the bank to file a currency transaction report with the Financial Crimes Enforcement Network within 15 days. That report includes your full legal name, social security number, date of birth, home address, the precise dollar amount, the nature of the transaction, and the exact time it occurred down to the minute. You will never receive a copy of this report. The bank is legally prohibited from informing you that it was filed. The report enters a federal database shared across the Financial Crimes Enforcement Network, the IRS Criminal Investigation Division, the Drug Enforcement Administration, the Department of Homeland Security, and approximately 400 additional federal, state, and local agencies. Once your name appears in that database, it remains there for 5 years. Every subsequent financial transaction is automatically cross-referenced against your documented history. But the currency transaction report threshold is not the rule that catches most ordinary Americans. The rule that actually matters is called the suspicious activity report, and it has no dollar threshold whatsoever. A suspicious activity report can be filed on a transaction of any size: $100, $500, $2,000. The decision to file rests entirely with the bank's internal compliance team, based on whether a transaction matches a behavioral pattern that their software categorizes as unusual. The bank must make that determination within 30 days of the flagged activity. The report goes into the exact same federal database. You will never be notified it was filed. You have no legal right to know that it exists. If a bank employee were to inform you that a suspicious activity report had been filed on your account, that employee would have committed a federal crime called tipping off, carrying a penalty of up to 5 years in federal prison. This is precisely why your bank cannot tell you when these reports are filed. It is also why banks have every structural incentive to file whenever there is any degree of uncertainty. A bank that files a report incorrectly faces 0 regulatory penalty. A bank that fails to file when its compliance team should have can face millions of dollars in fines, and the compliance officers personally responsible can lose their professional licenses. The incentive structure is completely asymmetric. File first. Ask questions later, if at all. 7 behaviors that trigger automatic compliance review. Bank compliance software is specifically trained to identify behavioral patterns that deviate from established norms. Understanding these patterns is essential for any retiree managing meaningful liquid savings. Behavior 1, a transaction that breaks your established historical pattern. If you have averaged $500 in weekly withdrawals for 10 years and you walk in requesting $8,000 on a Tuesday morning, the software flags the deviation regardless of your reason for needing it. It does not evaluate why the transaction is occurring. It evaluates the departure from your documented baseline. A retiree who has never withdrawn more than $300 in 15 years, requesting $2,000 to purchase airline tickets for a family reunion, will be flagged. The system has no context. It only sees the anomaly. Behavior 2. Multiple transactions that collectively approach the $10,000 reporting threshold. 2 $5,000 deposits on consecutive days. 3 $4,000 deposits across a single week. 4 $3,000 deposits spread across a month. Compliance software now evaluates rolling windows of up to 90 days, identifying aggregated patterns that individually stay below the threshold but collectively suggest awareness of the reporting requirement. This behavior is defined under federal law as structuring, under Title 31 of the United States Code, Section 5324. Structuring is a federal felony carrying up to 5 years in prison and forfeiture of the entire amount involved, even when every underlying dollar is completely legitimate. The documented cases in this area are genuinely sobering. A restaurant owner in Iowa operating for 38 years made deposits below $10,000 because her insurance policy capped the amount of cash permitted on premises. The IRS seized her entire account balance of $33,000 without filing criminal charges. It required 2 full years of litigation by a public interest law firm to recover her funds. A convenience store operator in North Carolina lost $17,000 to a structuring seizure and was never charged with any crime. A firearms dealer in Georgia had $940,000 seized and spent years in federal court before recovering it. None of these individuals were engaged in any illegal activity. Their deposit patterns simply matched the behavioral signature the software was trained to detect. Behavior 3. A wire transfer sent from an account that has not previously initiated or received wires. The first wire transfer from any retail account is treated as a high-risk event by compliance systems, regardless of the amount involved. Bank algorithms cannot distinguish between a homeowner wiring $3,000 to a contractor for a kitchen renovation and a fraudster moving $3,000 out of an exploited elderly person's account. The software flags both events identically. A human compliance officer reviews them afterward. Behavior. 4. Round number transactions in amounts near the reporting threshold. A deposit of exactly $9,000. A withdrawal of exactly $7,500. Compliance software is specifically programmed to identify clean, round number transactions near the $10,000 threshold, because that pattern is the behavioral signature of deliberate threshold avoidance. The profound irony here is that attempting to be tidy and organized with your transactions produces precisely the pattern the software is designed to catch. Behavior. 5. Account activity that is inconsistent with your documented income or occupation profile. A retiree receiving regular Social Security deposits who receives a $12,000 cash deposit from an unrecognized source will trigger a compliance review, even when that amount represents legitimate proceeds from selling a vehicle or surrendering an insurance policy. The solution to this specific scenario is advanced preparation. If you anticipate a large deposit from a non-recurring source, document the transaction before it arrives. Keep the bill of sale, the insurance carrier statement, or whatever documentation establishes the legitimate origin of the funds. When the compliance officer reviews the flagged transaction, that documentation is what prevents a suspicious activity report from being generated. Behavior. 6. Third-party deposits made into your account. If a family member visits your branch and deposits cash into your account on your behalf, the bank logs it as a third-party cash deposit, which receives elevated scrutiny automatically. The same elevated treatment applies to deposits made at branches other than your home branch, deposits left in night drop boxes, and deposits made immediately before or after the bank's stated operating hours. Any deviation from your established deposit pattern is now assigned a risk score in the compliance system. Behavior. 7. Transactions connected to flagged geographic regions or merchant categories. Compliance software maintains continuously updated lists of countries, area codes, and business categories that receive automatic elevated scrutiny. You do not need to be engaged in any problematic activity for this trigger to activate. The flag is generated by association with the designated category, not by any evidence of actual wrongdoing. A wire transfer to a contractor whose business address happens to fall within a flagged postal code can initiate a full review of your account. The inflation problem, damage that requires no federal involvement. Beyond the regulatory exposure, there is a straightforward mathematical reality affecting every dollar sitting in a conventional retail bank account. In 2026, the average national interest rate on a standard checking account is approximately 0.06%, 0.06%. On a standard savings account, the average is approximately 0.40%, less than half of 1%. The official inflation rate is currently running at approximately 3% annually. This means every dollar sitting in a conventional bank account is losing purchasing power every single month, regardless of anything you do or do not do. If you maintain $50,000 in a checking account earning effectively zero interest while inflation runs at 3%, you lose $1,500 of purchasing power in a single year. The dollar balance on your statement remains unchanged. The dollars themselves simply buy less of everything you need. Simultaneously, the bank is lending the money you deposited at rates between 7% and 12%. A bank holding $100 million in retail deposits and earning 0.40%, while lending that same money at 7%, is generating approximately $6.5 million annually from money that does not belong to them. Your money sits idle in their vault. They lend it out at profit. They retain the entire spread. You absorb the inflation loss. That is the complete business model of retail banking as experienced from the depositor's perspective. The FDIC insurance limit, the risk almost nobody considers. The Federal Deposit Insurance Corporation insures deposits up to $250,000 per depositor per insured bank per ownership category. If you maintain $300,000 in a single bank account and that institution fails, $50,000 of your balance is completely uninsured. That $50,000 is at genuine risk of permanent loss. In 2023, 3 of the largest bank failures in American history occurred within approximately 10 weeks of each other. Silicon Valley Bank, First Republic, and Signature Bank all collapsed in rapid succession. Insured deposits were ultimately covered. Amounts above the insurance limit faced significant uncertainty, and resolution in those cases depended heavily on political decisions made under extraordinary pressure, rather than on firm statutory guarantees. There is no legal requirement that the same favorable outcome will occur in any future bank failure. The next institution to fail could be yours. Bank failures rarely announce themselves in advance. How much money actually belongs in a retail bank account? The figure that experienced financial planners consistently arrive at for their own clients is between 3 and 6 months of essential monthly expenses kept in a checking or high-yield savings account, and not meaningfully more than that. For the median American retiree, that figure falls somewhere between $15,000 and $25,000. Every dollar above that threshold is simultaneously being eroded by inflation, generating surveillance data inside a federal compliance algorithm, and being used by your bank to fund lending operations at rates you will never benefit from. 5 accounts where liquid savings actually belong. Account 1. High-yield online savings accounts. Online banks including Ally, Marcus by Goldman Sachs, Discover, Capital One 360, and Wealthfront currently offer interest rates between 3.5% and 4.5% on savings accounts carrying full FDIC insurance up to $250,000. The money is completely liquid. Transfers to a linked checking account complete in 1 to 3 business days. There are no monthly maintenance fees and no minimum balance requirements. Opening an account requires approximately 10 minutes and your social security number, driver's license, and existing bank routing information. This rate is roughly 10 times what a conventional local bank savings account pays on the exact same dollar with identical federal deposit insurance protection. Account 2. Treasury bills. Treasury bills are short-term debt obligations issued directly by the United States government, available for purchase in increments as small as $100 through treasurydirect.gov, the official website operated by the United States Department of the Treasury. 4-week, 8-week, 13-week, and 26-week bills are currently yielding between 4.0% and 4.5% annually. Treasury bill interest is exempt from state and local income taxes for retirees residing in high-tax states, including California, New York, Oregon, and Hawaii. This exemption makes Treasury bills superior to high-yield savings accounts on an after-tax basis, without any reduction in safety or security. The practical approach for retirees is a Treasury bill ladder, staggering purchases across multiple maturity dates so that a portion of the portfolio matures and becomes accessible every few weeks while maintaining continuous interest accrual on the remainder. Account 3. Series 1. Savings bonds. Series 1. Bonds are inflation-indexed instruments issued by the United States Treasury with interest rates that adjust automatically every 6 months based on the official Consumer Price Index. By design, the interest rate tracks inflation, meaning the purchasing power of the invested amount is preserved regardless of the prevailing rate environment. Individuals may purchase up to $10,000 per Social Security number per calendar year directly through Treasury Direct. A married couple filing jointly may purchase $20,000 combined annually. I-bonds must be held for a minimum of 12 months. Redemption within 5 years of purchase results in forfeiture of the 3 most recent months of interest. After 5 years, redemption carries no penalty whatsoever. For retirees who can commit funds for at least 1 year, I-bonds represent the only investment in the United States guaranteed by federal statute to maintain pace with inflation under all economic conditions, regardless of what markets or interest rates do. Account 4, brokered certificates of deposit. A brokered CD is purchased through a brokerage account, such as Fidelity, Charles Schwab, or Vanguard, providing simultaneous access to CD rates from hundreds of banks rather than being limited to the single rate offered by your local institution. Current brokered CD rates range from 4.5% to 5.0% with full FDIC insurance on each underlying issuer. The structural advantage of brokered CDs for retirees with larger balances is the ability to distribute funds across multiple issuing banks within a single brokerage account interface while maintaining full FDIC coverage at each institution. A retiree with $1 million can spread funds across 4 separate banks at $250,000 each through one account with one login. Laddering brokered CDs across 3-month, 6-month, 1-year, 2-year, and 5-year maturities creates a structure where shorter maturities maintain rolling liquidity, while longer maturities lock in current rates against potential future rate reductions. Account 5. Government money market mutual funds. Money market mutual funds available through major brokerage platforms, including the Vanguard Federal Money Market Fund, the Fidelity Government Money Market Fund, and the Schwab Value Advantage Money Fund, currently yield between 4.0% and 5.0% by holding short-term United States Treasury obligations. These funds are not FDIC insured, but are backed by direct United States government debt obligations. They are completely liquid, with funds available within 1 business day. There are no holding period requirements, no withdrawal penalties, and no contribution limits of any kind. The recommended structure for retirees. The allocation that consistently produces the best combination of yield, liquidity, safety, and regulatory simplicity for retired individuals drawing Social Security, pension income, or required minimum distributions. 1 to 2 months of essential expenses in a standard checking account for daily transactions and routine bill payments. 3 to 4 months of essential expenses in a high-yield online savings account for near-term liquidity needs. 6 to 12 months in a laddered Treasury bill portfolio, providing rolling liquidity and federal tax advantages. Remaining emergency reserves in a brokered CD ladder spread across multiple FDIC-insured institutions at different banks. This structure generates between 3% and 5% annually on every dollar held within it. It maintains complete liquidity on a sliding scale from 1 business day to 12 months. It keeps every dollar either FDIC insured or backed by direct United States government obligations. And it removes the large idle balance from the retail bank account where compliance algorithms run continuously and silently. 3 specific situations. Retirees must plan for in advance. Required minimum distributions beginning at age 73. IRS regulations require annual withdrawals from traditional IRAs and 401k accounts. These withdrawals, often ranging from $15,000 to $40,000 annually, arrive as large, unexpected deposits that can trigger compliance review at a retail bank that has no established pattern for receiving them. The straightforward solution is directing RMD deposits to a high-yield savings account or brokerage account rather than a primary checking account. Pension lump sum elections. Retirees offered a lump sum pension option in lieu of ongoing monthly payments may receive transfers of $100,000 or more at once. These amounts should be directed by wire to a brokerage account rather than a retail checking account. Brokerage platforms are structurally built for transactions of this magnitude and do not operate the same retail compliance algorithms that flag large deposits at community banks and credit unions. Survivor benefit deposits, life insurance payouts, Social Security lump sum adjustments, and retirement account beneficiary distributions frequently arrive during periods of acute grief, when the surviving spouse is least emotionally equipped to manage compliance inquiries from a bank. Having a separate account already established at a different institution before any anticipated deposit is the most effective preparation available. The deposit flows to the prepared account. The primary bank never sees it. The compliance algorithms never activate. The practical first step. The single most impactful initial action for any retiree currently holding more than $30,000 in a conventional bank account is this. Open one high-yield savings account at an online bank this week. Transfer everything above $30,000 out of the local bank. Begin a treasury bill ladder with any funds beyond the 6-month expense reserve. That single action, applied to a balance of $150,000, generates between $4,000 and $6,000 in additional annual interest. With no increase in risk, no meaningful reduction in liquidity, and no ongoing complexity once the initial setup is complete. Over a 25-year retirement, that compounded difference amounts to between $120,000 and $180,000 in additional wealth generated entirely from money you had already saved. Simply move to where it earns what it should have been earning all along. Your bank will not suggest this. There is no financial incentive for them to do so. The information has always been publicly available. The accounts have always existed. The only thing required to access the benefit is the decision to act. The money you worked a lifetime to accumulate deserves to work just as hard as you did. The accounts described above are where that actually happens. This content is educational and informational in nature. It does not constitute financial advice, tax advice, or legal advice specific to any individual situation. Interest rates, regulatory thresholds, and compliance procedures are subject to change without notice. Consult a licensed financial advisor, enrolled agent, or qualified tax professional in your jurisdiction before making decisions regarding account structure, asset allocation, or significant financial transactions. Subscribe to Senior USA Hub for more content that keeps you informed and protected.